Hey everybody, so in this video I want to talk about pro forma income statements. So I'm on this website, it's called Wall Street Mojo, and I'm really just here to read you a definition. Just so you know, I'm not making this stuff up. So it says right here, a pro forma income statement is a statement prepared by the business entity to prepare the projections of income and expenses which they expect to have in the future by following certain assumptions such as competition level in the market, size of the market, and growth rate. So we are going to make a pro forma income statement with NVDIA. So right now I'm on NVDIA and I'm on their Q3 press release. So on their press release, they actually give us Q4 data. So this is Q4 data that is actually an outlook. So this is a forecasted number. It's not the actual numbers that are going to happen. It's forecasted. So this is what is going to make this a pro forma income statement. So right here it says NVIDIA outlook for the fourth quarter of the fiscal year 2023 is as follows. It says revenue is expected to be $6 billion. GAAP and non-GAAP gross margins are expected to be 63.2 and 66%. So right here it says GAAP and non-GAAP. We want to follow GAAP because that is generally accepted accounting principles. So non-GAAP will basically just leave out some certain things. So like for example, stock-based compensation, they might add that back in. So that's just one example. Now right here it says GAAP and non-GAAP operating expenses are expected to be approximately $2.56 billion. So that's the number we want to use. It says right here GAAP and non-GAAP other income and expenses are expected to be an income of approximately $40 million. Right here it says tax rates are expected to be 9%. So here is this pro forma income statement outline that I created. So right here we have revenue, we have cost of goods sold, and you're going to notice that I put this little black line here. This little black line here basically lets us know, hey, you know what? We're going to have a subtotal. So, if I get revenue and I subtract it by cost of goods sold, then that's going to give us this subtotal, which is gross margin. Now, if I get gross margin and I subtract it by operating expense, that's going to give me another subtotal called operating income. Now, I get my operating income, I either add it or subtract it to this other income or other expense. But here it's other income, so I add it. So when I get this operating income, I add the other income, then I get the subtotal called taxable income. So now when I have my taxable income, I'm going to get the income tax rate and I'm going to multiply it by the taxable income. And then from here, I'm going to get my taxable income, subtract it by my income tax, and then I get net income. So this double line right here lets us know, hey, we are finished with our calculations. This is the bottom line. So that is net income. So now we're going to go ahead and we're just going to plug all of these numbers in. So right here it says revenue is expected to be $6 billion. So right here I have this note right here that says all numbers in millions. So if we're putting in 6 billion here, that's going to be 6,000. So cost of goods sold, what is cost of goods sold? So they don't actually give us this, but instead they give us gross margins, and they say that's 63.2%. So 63.2% of what? It's 63.2% of sales, which is revenue. So right here we're going to do equals 0.632, and then we're going to multiply that by revenue. So that is the number that we got. Let's go ahead. Let's make all of this look pretty. So we're going to do the decimal right there. And then we're just going to remove, no, let's keep those zeros right there. So what is the cost of goods sold? Well, the cost of goods sold is actually just this intermediate calculation that's not being shown here. So if I want to show this, it's really just this revenue minus the margin. So what's actually going on here is, I got revenue of $6 billion. Now, what is the cost of that revenue? What is the input cost of those materials and all of the other things? That's basically $2.2 billion. So that gives me a gross margin of 3.792 billion. So now I have these operating expenses. So what is this operating expense? Well, it says right here it's approximately 2.56 billion. So we're going to go ahead, we're going to plug that in. That's 2,560. All right, so what is our operating income? So our operating income is literally just this gross margin minus operating expenses. There we go. And what is other income? So like I told you guys, it could be other income or it could be other expense. But right here, they told us it's going to be income of approximately 40 million. So let's go ahead, let's plug that in. So what is our taxable income? Our taxable income is just the sum of these two items. So it's the operating income plus other income. So this is what we're going to be taxed on. So what is our income tax rate? Let's see, it says 9% right there. So I'm going to take 9%, so that's equals 0.09, and then we're going to multiply that by this taxable income amount. So, now we have income tax, and we're going to do taxable income, and we're going to subtract it by income tax. And that is going to give us this bottom line number of $1.157 billion. So that is our net income. So what about this diluted shares portion? If we want to calculate earnings per share, we're going to need to know this. So here's what we can do. So we can go ahead, we could look for the income statement. And it says right here, the diluted shares is 2,499,000,000. So we don't necessarily know what the diluted shares are going to be for the next quarter, but we can make this assumption and we could just use the same amount and assume that it's not going to change a whole lot. So that is one assumption that we're making right there. So we're going to go ahead and plug that number in. So that is 2,499. All right, so what is the earnings per share? The earnings per share is always going to be net income divided by the diluted shares outstanding. So that is 46 cents. So that's essentially how you calculate that. And let me just show you one more thing. So you think, hey, is that good or is that bad? Well, this is how you're going to know. You're going to go one step back. You're going to look at Q4 of 2022. So here, we don't have this quarter yet, but we basically just calculated it in our pro forma income statement. So now I'm going to go to Q4 of 2022, and I'm going to see what they did the last year, same quarter. So right here, the last year, same quarter, they did $1.32 in diluted earnings per share. Here, we're only doing 46 cents. So yeah, that's not too good, you guys. Now, if you wanted to go one step further, you could do the entire year's earnings per share. And essentially, I'm going to show you guys how to do that as well. So I was just going to stop there earlier, but I feel like I'd do you a big disservice if I didn't show you all of this. So we're going to go from Q1, Q2, and Q3 just to grab all the diluted earnings per share numbers. So right here, it says $1.36 for Q1. So let's just put right here Q1. That was $1.36. Here we're going to put Q2. Let's go ahead and figure out what that number is. So that is 26 cents. So it's pretty crappy right there. Now we're going to put Q3. 27 cents, also pretty crappy. All right, and then now we're going to do Q4. So Q4, we already have Q4 because we calculated this, but this is an estimated amount. So now we're going to do 0.46. And then now we're just going to calculate the total. So now we have the full year of earnings per share. And that is basically saying, hey, you know what? Total year's earnings per share is expected to be $2.35. So let's say we want to calculate PE from this. Now, if I want to calculate PE, I'm going to need to know two things. I'm going to need to know the stock price and I'm going to need the earnings per share. We already have the earnings per share. So the stock price, you know, this is going to change all the time. So let's just say right now, you know, let's just say it's going to be 155. I don't know what it actually is, but let's just say it's going to be 155. So now let's just calculate the earnings per share, or the PE is what I mean. We're going to calculate the PE. So the PE is essentially just going to be the stock price divided by the earnings per share. So there you go. In this scenario where the stock price is $155, you know, your PE multiple is going to be 66. Now, is this good? Is this bad? Well, that's going to depend on the growth. So, you know, go ahead, watch my prior video where I talk about NVIDIA having 0% growth for the full year of 2023, the fiscal year of 2023. So go ahead, watch that video. I'll link it down below. And I hope you guys enjoyed this video right here.